Welcome to another one of our investment market videos. An expert in perhaps the most talked about asset class of 2021. I have the huge pleasure today in speaking to Jim Wright, manager of the premier Miton Global Infrastructure Income Fund. Bit of a mouthful. But before we start, if you've not subscribed to the channel, it would be fantastic to get your support by clicking on the subscribe button below. And if you found the content to be of interest, please click the like button also. So, Jim, many thanks for joining me today, and happy New Year. For those investors that are unaware of infrastructure as a distinct asset class, what is it?
Yeah, it's a good question, and there is no dictionary definition, but essentially the way we view it is assets which are basically essential for the functioning of society. Now, you can include all sorts of things in this, property, housing, doctor surgeries, hospitals, all kinds of social infrastructure. We narrow it down in our fund to economic infrastructure.
Right.
So that essentially means four areas. We keep it really simple. So regulated utilities and renewables, so all the gas, electricity networks, power generation, etc., would be one. The second would be telecom infrastructure, so all the stuff that enables high-speed data, enables stuff like this. So fiber networks, mobile telco towers, all that sort of thing would be the second. The third is a sector which kind of exists more in North America, which is oil and gas, energy infrastructure, pipelines and storage and so on. Still a very important sector, even though obviously fossil fuel use is declining and will decline further. It's still a vital sector for the functioning of those economies. And then finally, transportation, and that spans rail networks, ports, airports, bus and coach networks, toll roads, all the stuff that essentially keeps people and goods moving, and again therefore facilitates the function of the wider economy. So that in a nutshell is what we see as infrastructure.
When we last spoke at the back end of last year, prior to the US presidential election, your thought that there would be a Democratic blue wave, and that this event will be positive for infrastructure investors. To be fair, you must be feeling pretty pleased with yourself.
Yeah, it doesn't do to get carried away in markets, as you know. They can always come back and bite you. But yeah, look, I mean, it took a while. It obviously took till the Georgia runoff elections last week or the week before last, but we do now have Democrat control of the presidency and both chambers of Congress, the House and the Senate. And what that enables a president to do is clearly enact more, crack on with his agenda. Essentially, you still need support from legislators, and as we know, they all have their own personal agendas, but it makes it more straightforward. And I think so far from President-elect Biden, we've seen the first stage of his stimulus, which is basically that reaction to COVID-19 and kind of just supporting people who've been hit hard by the pandemic. But the second stage, and I think he'll talk about this a lot in his inauguration, and then we'll get there's always this mystical first 100 days with any US president. Within that, we will get concrete plans for a big infrastructure program, north of $1 trillion, focused on, I think, green themes, focused on the energy transition. And that's a great theme for us as investors. That's what I've been, we've been investing in it. This has been happening in the US over many years, despite a Republican president, but will clearly gain an extra momentum under President Biden.
Yeah. moving on from there, how are you positioning the fund, and what are your expectations for 2021, if any?
Yeah, so we like to think about two things when we position a fund. People, why do investors own infrastructure? Fundamentally, it's because we can offer a safe, solid, reliable, consistent flow of cash flows and flow of dividends to investors because of the underlying assets that our companies own. The telco masts and the rail networks and the electricity networks, they're all providing a safe, secure flow of income that doesn't tend to be hit too much by the waves in the global economy, by the sort of boom bust waves. But the other aspect of infrastructure, which we believe in and we think is probably a little bit underestimated, is the exposure to long-term growth themes. If you think, Andrew, over the next 20 years, over our investment lifetimes, I think there are two themes which are absolutely core to us as investors. One is the energy transition. Goldman Sachs recently said we're in year 3 of 30 in terms of moving away from carbon emissions, reducing carbon emissions, changing the generation fleet from coal and gas to renewables, and then electric vehicles, electric home heating, all these other themes that we need to decarbonize the economy. So that will be one. The second is just the continued exponential growth of high-speed data for our communications, for connected devices, for driverless cars, ultimately. We can invest in these themes today. We can invest in these themes. They're long-term themes. But if I look at the US, if I look at the next 12 months, the drive for decarbonisation, the drive for switching away from coal to renewables, the starting to build electric vehicle charging networks, starting to invest in electricity networks in the big cities, this is happening today. And, as I say, the great thing I think about this asset class is, we can get these solid, safe returns today, but we can also get exposure to these huge growth themes over the next 10, 20, 30 years.
And final question, and for full disclosure to viewers, Jim's fund is contained within our investment portfolios that we manage. A theme or a situation that I've been looking towards is starting to raise its head in inflation. How does infrastructure and infrastructure investments benefit an investor who's perhaps looking to hedge from inflationary forces?
Absolutely. So if you think of the assets that we own, we own 46 stocks in the fund, the underlying assets that they own, something like an electricity network, it's regulated. It has to be, it's a monopoly asset. The regulator will look, and it depends, different countries have different timeframes in regulation, but they'll look over the next 2, 3, 4, 5 years, what's a fair return for the equity investors, for the company that owns this network. But crucially, in most jurisdictions, they will link that to inflation. They will give you a local inflation kicker to that return. Similarly, in a telecom tower, when the telecom operator pays for a 20-year lease to put their antenna on a tower, they will pay an annual fee. In almost every case, in almost every market, it's linked to CPI. It grows with CPI. So across our portfolio, we think that around about 70% of the underlying revenues have some sort of explicit inflation linkage. So what we know is that if inflation picks up, and as you say, there is certainly a school of thought that may happen, 70% of our revenues will automatically grow to capture that inflation growth. Now, the costs of the companies will grow as well. It doesn't necessarily mean profits will grow, but it gives you a hedge. As you rightly say, if inflation is, it's stronger than we expect, it gives you a hedge. Lots of other equity sectors and bond sectors will will not have that hedge.
Yeah.
We are pretty unique in having that inflation linkage in our underlying stock returns.
Mm-hmm. Well, it seems like 2021 could perhaps be the year of infrastructure, and moving forward, hopefully people will be able to allocate more to infrastructure from an income situation, from an inflation hedge, from the growth opportunities as well. So it seems pretty exciting. Jim, once again, many thanks for taking the time to speak, and I'm sure we'll catch up soon.
Thanks, Andrew.